So as we have seen in our cash flow statements, the cash basis performance measurements are good enough and it's relatively easier to understand. But let us show you some situations where it's very difficult to capture a company's performance just based on cash flow, cash inflows and outflows. So let's say there's a case where a car company sold a car worth, 50 grand at the end of December. So they've sold it at the end of December, but payments were made in receivables rather than cash. So the cash wasn't collected yet at the end of December, and the cash is expected to be collected next January. So in this case, should the company record sales worth 50K? I'm sorry about the numbers, but anyways, should the company record the 50K sales in December, or should they record it in January when the cash is actually collected? So cash basis, financial reporting, sales would be recorded in January. But from the person who have sold the car's point of view, he wouldn't be very happy if his performance was based on cash collections. He made the sales in December. That should be recognized in December, and that should be reflected in his year-end bonus or something. So instead of recording sales at the point of where the cash is collected, they're recording sales at the point where the salesman has done his duty. That's accrual basis. There are millions of cases where the cash inflow and outflow does not match performance-based sales or performance-based costs. So that's where everything happens. That's where accounting starts, and that's where it becomes very frustrating and difficult to understand. We have another case where this is a very common case actually for many companies across the globe. So your salaries, so if you work in December, your salaries are, in many countries, they're paid the next months. So you've worked in December, but you're being paid in January. And from the company's point of view, when to record the labor cost expense? Should it be recorded in December, or should it be recorded in January where the actual cash outflow occurs? In accrual basis accounting, we record the costs in December, where the costs have actually occurred. But instead, if you're doing the cash-based performance measurement, the cost will be recorded in January. So those another example of cash outflows and inflows being different from accrual basis. Number 3, let's say our company constructed a very big automobile equipment plant. We invested like $1 billion, and we're going to use it for the next 10 years. Let's say a company did this. Should we record the $1 billion in just 1 year? Or we're going to use it for the next 10 years. So should we split it by 10 and record expenses over the 10 years by $0.1 billion, which makes more sense. In cash-based accounting, as you have noticed, we would probably record a $1 billion expense at the point where cash has, gone out. But in accrual basis accounting, we're trying to match the periods where we're actually using this equipment plant to the actual expenses and actual usage of the plant. And for those who don't know, that's called depreciation. So splitting the initial capital expenditures to the useful year and then recognizing expenses by each individual period. So we have seen 3 cases where cash inflows and outflows do not match performance measurements of companies. And now let's discuss further about the accrual basis concept of accounting.